if I were to look at the three main product lines that we help you with, the advisor, this is the one area to where the math and the science, you cannot argue against this. Guaranteed lifetime withdrawal benefits. The whole notion of the inverse of life insurance to argue against guaranteed lifetime withdrawal benefits is, unless you're giving big promises that the stock market's going to do this and that, unless you're doing that, the math and the science to argue against guaranteed lifetime withdrawal benefits would be equivalent to arguing against the merits of life insurance, right? Because what is life insurance? Well, life insurance is, how do we do this? How can I, Charlie, write an insurance company a check today for, say, $1,000, and if I get hit by a bus tomorrow, you mean to tell me that that insurance company is going to pay my beneficiaries with life insurance $1 million? Sounds too good to be true. Nobody asked that because life insurance has been around for a couple hundred years, right? How are they able to do that? Well, because the people that live too long pay for those that die too early. And GLWBs is the inverse of life insurance. Those that don't outlive their retirement savings, so to speak, and pay that 1% per year fee, that pays for those that live a long time. These are mortality credits. Those people that die early pay for those that live too long. Of course, over time, there have been various levels of attractiveness with GLWBs, but I'll tell you, the payouts have never, ever, as I already alluded to, have never been as high as they are today. I use the example, then I'm going to give you a little whiteboard diagram, then get into the other goodies here. My policy, 2 years ago, I said, dang, I'm 46. I'm getting old enough that I can actually buy these GLWBs, right? So what did I do? I put $200,000 into an American equity policy. Why? Because I ran the report that I would also run you guys for your clients, an annuity rate watch report, and boom, they were at the top. Charlie, you buy this for 200 grand at 46. By the time you and Noelle, your wife, hit age 65, you'll be guaranteed $44,000 per year in income forever. So think about, some people are like, well, but I could buy a 30-year treasury bond and they're paying whatever they're paying now, 5% or whatever. I could buy a 30-year treasury bond, but you still have that reinvestment risk, right? What are treasury bonds going to be at the end of that 30 years or 20 years or whatever? This is the only product that I know of that would guarantee me and my wife all the way, for another 50 years or whatever, $44,000. And of course, the analytical person says, okay, but I have a lot of money in the stock market. What is the downside of moving 200 grand out of the stock market? In other words, what is my rate of return on my internal rate of return, to get technical, on my cash flow out to, say, age 90? One of us is going to live to 92. That's how life expectancies work. One of a couple is going to live to 92. At least that's for a 65-year-old couple. One of a couple is going to live to 92. What's my internal rate of return without reinvestment risk again? And it was over 6% or something. So does that make sense to move a portion of my portfolio into this GLWB? Only 200 grand. That's going to pay us $44,000 per year. That's exactly what I did, right? And when you can talk about when you understand the math and the science around these GLWBs versus the trolls on LinkedIn, well, but if the stock market's gone up 10% per year, then on 200 grand, you should be guaranteed, it grows to a gazillion bucks, then you should be effectively guaranteed 100 grand per year in income. That's not the way the stock markets go, right? That's not the way stock markets grow. There's something called sequence of returns risk. But when you understand the math and the science, that's when you get, okay, Ramsey, somebody said, that's when you get excited about these products, but they can be complicated, right? So how do I explain this?